This presentation covers federal tax law changes for tax year 2024. You can always find changes, that is at least for the most recent publication date, in IRS publication 4491. That's the VITA TCE Training Guide. And the changes start on page Roman numeral 9, which is at the front of the document. I want to start out by saying that there really haven't been any major changes to federal tax law this year. Certainly nothing like the changes made to the residential energy credits in 2023. Now, a lot of the major changes over the past few years were due to the pandemic. After years of stimulus payments and pandemic tax breaks, nearly all of those extra benefits have faded away. Having said this, please be aware that the IRS found that many people who filed a tax return in 2021 failed to claim the recovery rebate credit. As a result, the IRS is currently issuing automatic payments of the rebate credit to approximately 1 million taxpayers. Now, there are no tax implications. Just be aware that taxpayers may ask whether the payments are taxable and what they need to do. These are refundable credits. The taxpayers will not need to report as income on their 2025 tax returns. Now, there are really only 3 changes of any significance in 2024. They're highlighted on this slide in red. The 1099-K reporting threshold, exceptions to the 10% early distribution tax for IRAs and other eligible retirement plans, and 529 rollovers to Roth IRAs. We'll cover these changes first. We're going to then discuss some changes to tax provisions affected by inflation. Although there are 63 separate tax provisions that are affected by inflation, we'll only discuss a few of them, including tax brackets and standard deductions. The 1099-K reporting threshold. The IRS had planned to require third-party payment organizations like PayPal or Venmo to start issuing 1099-K forms for any gross payments over $600. But following feedback from taxpayers, tax professionals, and payment processors, the Internal Revenue Service decided to delay the new $600 reporting threshold and take a phased-in approach by gradually reducing the threshold over a few years. So in 2023, the threshold was set at $20,000. And in 2024, the threshold is reduced to $5,000. The IRS has also eliminated the transaction threshold. It had been 200 transactions in 2023. That meant that regardless of the dollar amount of the gross payments, a taxpayer with 200 or more transactions was to be issued a 1099-K. And this is no longer a transaction threshold. It's no longer there in 2024. So if a taxpayer receives a single payment of $5,000 or more, the payment organization is required to issue a 1099-K. Now, although the IRS is taking a phased approach and companies aren't required to provide 1099-K forms for gross payments under $5,000 in 2024, IRS personnel have told members of the Tax-Aide National Tax Training Committee that they believe we'll see a lot more 1099-Ks this year. That's as some companies are transitioning to lower thresholds earlier than required. So the threshold will be reduced to $2,500 in 2025 and to the target of $600 in 2026. It's important to note that the threshold does not affect actual tax law to report income on tax returns. All income, no matter the amount, is taxable unless it's excluded by law, whether a Form 1099-K is issued or not. Normally, a 10% penalty is assessed for an early withdrawal made from an eligible retirement plan, including traditional IRAs. That's before a taxpayer reaches the age of 59 and a half. The 10% penalty is not applied when Form 1099-R has a code of 2 in box 7. But in other cases, we need to determine whether the reason for the early distribution qualifies as an exception to receiving the 10% penalty. Now, the IRS has created a list of allowable exceptions. This year, the IRS has added 2 more exceptions to the list, the first being for domestic abuse. So first, the IRS defines the term domestic abuse as physical, psychological, sexual, emotional, or economic abuse, including efforts to control, isolate, humiliate, or intimidate the victim, or to undermine the victim's ability to reason independently, and including by means of abuse of the victim's child or another family member living in the household. Now, this exception is self-certified by taxpayers. We're not involved in deciding whether they qualify. There are limitations placed on this exception. First, the distribution must be within 1 year of the abuse. The maximum distribution is $10,000 or 50% of the IRA's balance, whichever is less. It applies to IRAs and other eligible employer plans, but not pensions or annuities. The distribution can be repaid and is considered a rollover if the account has basis, meaning some of the funds have already been taxed. We'll need to prepare Form 8606. We won't cover that here. Now, at the bottom of this slide is the exception description from the list of exceptions in NTTC publication 4012. Information on this specific exception can be found in IRS Notice 2024-55. Next is the emergency expense exception. This is allowed to cover unforeseen or immediate financial needs for self or family. Note that this exception, similar to the domestic abuse exception, is self-certified. If a taxpayer says it was an unforeseen or immediate need, to them an emergency, that's their decision. The distribution amount is limited to $1,000 as long as the account balance after the distribution remains above $1,000. As an example, if the initial account balance is $1,500, the taxpayer can only claim the exception for $500. One distribution is allowed per calendar year. No distributions are allowed for 3 years after a distribution unless it's repaid or elective contributions are made to the plan. So if a taxpayer makes contributions to their IRA, that would reset the clock. A repayment is allowed within 3 years. It should be noted that there's a question in the advanced tax exam that deals with this issue. Remember, the taxpayer determines what to them is an emergency expense. It could be a new tire for their car, let's say, that allows them to travel for work, but that's their decision. Let's do a quick refresher on how exception codes for early distributions are entered into TaxSlayer. Once we've entered the distribution information found on a 1099-R, TaxSlayer will know that the distribution is for a taxpayer who's under 59.5 years of age, and will assume there's a penalty unless box 7 on the 1099-R has a code of 2 in it. That's where the payer knows an exception applies. Now, assuming this is not the case, the screen shown here will be displayed to request we specify what type of plan the distribution came from. If the distribution was from, let's say, a traditional IRA, we would click on the button for Retirement Plan, shown here. To claim an exception, we would need to generate a Form 5329. We do this by selecting the form, which we can find using the Form Finder capability in TaxSlayer. That's shown in the upper left of this slide. That'll display the input form shown on the right. We can enter the amount of the early distribution that's exempt from the penalty in the box that says early distributions that aren't subject to 10% tax. And then click on the down arrow in the Select the Reason for Exemption box to see a list of allowable exceptions. Here's what the list of early distribution exceptions looks like. Please note that the exceptions for abuse and emergency expense have not been added to TaxSlayer at this point in time. We're hoping they will prior to tax season. They have been added to publication 4012. A 529 plan is a tax advantage savings plan for college and other post-secondary training, or for tuition in connection with enrollment or attendance at an elementary or secondary private, public, or religious school for a designated beneficiary, like a child or grandchild. Now, under the Secure 2.0 Act, the tax law was changed to allow savers to roll unused funds in a 529 into the beneficiary's Roth IRA without a tax penalty. But there are rules that must be followed, and these include a lifetime limit. Taxpayers can roll up to $35,000 in their lifetime. An annual contribution limit. The amount taxpayers roll over must be within the annual contribution limit for the Roth IRA. For 2024, the limit is $7,000 or $8,000 for those 50 and older. Now, the beneficiary, it must be in the name the same as the 529 plan beneficiary. The account age, so the 529 plan must have been in existence for at least 15 years. The rollover funds, those that are rolled over must have been in the plan for at least 5 years. Earned income, well, the beneficiary must have earned income equal to at least the amount transferred in any year. So if a taxpayer wanted to roll $7,000 to a Roth IRA from a 529 plan where they're the beneficiary, they'd need at least $7,000 of earned income. Now I checked, and Massachusetts treats 529 rollovers the same as the IRS. They're not taxable if the rules are followed. On a yearly basis, the Internal Revenue Service adjusts more than 60 tax provisions for inflation to prevent what's called bracket creep. Now, bracket creep occurs when inflation, rather than real increases in income, pushes people into higher income tax brackets or reduces the value they receive from credits and deductions. The IRS uses the Chained Computer Price Index, that's a CCPI, to adjust income thresholds, deduction amounts, and credit values accordingly. Now, the new inflation adjustment for tax year 2024 is 5.4%. Looking ahead, the IRS has already released adjustments for tax year 2025, factoring in an estimated inflation rate of 2.8%. So there was a 5.4% increase in the bracket dollars, which expanded the amount of taxable income taxpayers can have in each bracket. But the tax bracket rates didn't change. There's still the percentages shown in this slide, the lowest being 10%, the highest at 37%. Generally, wider tax bracket thresholds will reduce tax liability from most taxpayers. However, the most pronounced impact of this is felt by those taxpayers in higher brackets. Now, these adjustments may not lead to an increased refund for taxpayers, as their withholding rate would have been reduced along with their reduced tax liability. I mentioned there are more than 60 tax provisions that are adjusted by the IRS every year. Now, besides the tax brackets, we'll just take a look at a couple of the major provisions and how they change for tax year 2024. But first I want to provide a brief discussion of how tax brackets work, because we've probably all heard some variation of a taxpayer who complains because they're in the 22% tax bracket and believes that means they're paying 22% tax on all of their taxable income. Here's an example using the 2024 tax brackets of the tax a taxpayer would pay if their taxable income was $100,000. Notice that taxable income in the first tax bracket is subject to a 10% tax. Also notice in the far right of this tax bracket that it covers $0 to $11,600 of income. The 12% tax bracket below covers any taxable income between $11,601 and $47,150. And the 22% tax bracket covers any income between $47,151 and $100,525. I've shown the top of the 22% tax bracket out on the far right of this slide. In the case of someone with $100,000 of taxable income, their first $11,600 would be taxed at 10%. Just doing the simple math, this means they'd pay $1,160 on the first $11,600 of income. The next tax bracket places a 12% tax on taxable income between $11,601 and $47,150. That's $35,550 being taxed at 12%. That results in $4,266 of tax. As the next tax bracket of 22% covers taxable dollars between $47,151 and $100,525, the remaining taxable dollars would all be taxed at this rate. That's 22% of $52,850 or $11,627. So the total tax on $100,000 of taxable income is $17,000 and $17,000, I should say, and $53. This means the overall or effective tax rate is 17%. It also means the taxpayer would have been taxed 22% on the next $525 of taxable income and start paying 24% tax on anything above $100,525. One adjustment the IRS makes is to the standard deduction in an attempt to safeguard taxpayers against the growing cost of living. Here are the changes in the standard deductions based on filing status. I just wanted to show one pretty frequent situation for the taxpayers we support. So a married couple filing jointly and both spouses are at least 65 years of age, over on the right-hand side of the slide, their standard deduction for the tax year 2024 would be $32,300. That's why there are a lot less taxpayers who itemize versus a few years ago when the standard deductions were far less. By the way, figures are that prior to deductions changing a few years ago, 31% of people itemized. Now that's well below 10%. At some sites, it's down to about 3 or 4%. Okay, we'll move through the next slides pretty quickly. Long-term capital gains are also adjusted based on an inflation factor. Here's a comparison of the 2023 and 2024 long-term capital gains rates. You'll notice as an example, in 2023, a single filer paid 0% capital gains rate for income between $0 and $44,625. In 2024, the upper limit was raised to $47,025. You can see similar amounts in terms of raises for 15% and 20% versus the prior year. Here's a comparison of the IRA contribution limits between tax year 2023 and tax year 2024. Note that the catch-up contribution remained at $1,000. That's the same as 2023. Now also shown are the modified adjusted gross income phase-out ranges for Roth IRA contributions and the traditional IRA deductibility phase-out ranges. Now, by the way, for married filing separately, different rules apply based on whether the taxpayer lived with their spouse for any amount of time during the year or did not live with their spouse at any time during the year. A very important tax credit that's critical to some of our taxpayers is the Earned Income Tax Credit. So we want to ensure the taxpayers receive the full amount they're eligible for. The maximum amount allowed in 2024 is $7,830 for 3 or more qualifying dependents. The other maximum credits based on number of dependents, including 0 dependents, are also provided in the chart. One of the qualifications is that a taxpayer must have no more than $11,600 in investment income. That number was $11,000 in 2023 and continues to be adjusted based on inflation. When performing quality reviews, I like to keep a copy of this chart handy. It's an easy way for taxpayers to see why they qualify for a certain amount of the EIC or none at all. Now the dashed lines represent taxpayers using a filing status of married filing jointly. The solid lines represent all other filing statuses. The line colors represent the number of dependents including the maroon-looking color for no dependents located at the bottom of the chart. Now, notice that the credit amount, the vertical dimension over here going up, that increases, excuse me, as the income, which is horizontal, goes out in this direction. So the credit reaches a plateau. And we'll use an example of one child. We start here at 0. As income is moving in that direction, moving out, then the amount of the credit increases, increases, and increases till it reaches a maximum level, and then it plateaus across that level, and at a certain dollar amount, it begins to fade down to 0. So the sweet spot is for taxpayers using, let's say the one child example is right there where that plateau is. Same thing, there are plateaus for 2, for 3, and even a small one here for no children. Now, be wary of taxpayers who try to leave out income such that they qualify for more of the credit, or try to in some way find income. I've seen people who have run into several taxpayers who tried to decrease the amount of income they had, or at least report less income, so that they could either get some of the credit or get more of the credit, push themselves, in effect, back up, higher up, getting higher, more of the credit. This is a check to test sound levels for this slide.